All right, so good morning, everyone. Welcome to the new week. This is the macro snapshot. It's Bastille Day, so the 14th of July, 2025. Recording this at about 7:45 in the morning. Okay, so let's just look and see what's going on. Quite an interesting week in terms of data, but just quickly catching up over the weekend. News. I guess the main news in theory was Trump's administration announced the possibility from August the 1st of 30% tariffs on Mexico, the European Union, also on Canada, although maybe excluding certain sort of elements in Canada, which fall under the US CMA agreement. But basic idea here is that more tariffs are coming. Now, the market has remained relatively sanguine. If we just look quickly here at the ES futures, which of course opened, as usual on Sunday night at 6 p.m., we see that they did gap down a little bit, maybe like 100 ticks or so, but already just on this daily chart, you can see here that they're sort of already coming off lows. Now, there's a little bit of a gap here, but the point is that the market is remaining sanguine at the moment and relatively sort of non-volatile. And if you actually look at the VIX here, you can see that the VIX, has gone up a tiny bit, but still we're only trading at about 17.5%, which is just off of these recent lows, and so definitely at the bottom end of the range where we've been since, where you could argue, all year, apart from that sort of liberation spike. So if you compare the Liberation Day spike on April the 2nd, where Trump initially announced his sort of plans for tariffs, look at this on the VIX and compared to the announcement over the weekend. So you can see here that the market is essentially saying to Trump, okay, that they believe that these tariffs are just a negotiating tactic, that they will be there will be sort of watered down substantially. And that basically the theory seems to be the taco theory that Trump always chickens out, is to say that even when the market is at highs, Trump's rhetoric seems to ramp up. And if the market were to fall, he would probably come in with some compromises. So the market is essentially saying, we're going to wait and see what the Fed does. We're going to wait and see what earnings seasons does before making, much more of a sort of a comment or a real move here. Let me just move something here on my charts. Seems to be a bit stuck. Sorry. There we go. Sorry, everything's freezing. Now, even if the market were to sort of fall, sorry, my charts are computer's freezing here. You see that even down, let's say something like the 50-day moving average would only be down sort of 4%. So it's possible that, if the tariffs sort of do kick in a little bit, could the market fall? But at this point, we're still at the highs. And as I said, even going back to the 50-day moving average, which does no real technical damage to the chart, would only represent, about a 4% drop. Now, other news which came out over the weekend, or should I say other gossip, was this idea that Powell of the Fed is very close to resigning. I personally don't think that's true. There's obviously been sort of a lot of political sort of machinations in the background, and there's sort of these sort of comments coming out that somehow Powell at the Fed has used funds inappropriately to sort of renovate and rebuild and redecorate the building of the Federal Reserve. So it seems to be clear that certain people in the administration in Washington are looking for cause, as they call it, to fire Powell. But I don't know. Now, if that were to happen, I don't think Powell will resign. But if that were to happen, that would be seen as a huge politicization of the Federal Reserve, which of course would be a lack of sort of confidence in the reserve. I think would see the US dollar sell off hard. I think gold would go up, and I think would get a huge steepener, as the logic would be that, or two things, that the incoming Fed chair would have to be a dove, and sort of aggressive rate cuts would be incoming. And therefore the front end yields would come down, which would steepen the curve. And secondly, the idea there would be that it's a similar idea that, the incoming chair Fed would be less aggressive in the fight against inflation, which therefore, of course, is not great for the long end of the curve. And that would sort of steepen. So it would have a pretty aggressive steepener there if that were to happen. If Powell were to be fired, or he decided voluntarily to quit. I don't think it's in his nature, but clearly there are political machinations going on around the sort of White House. The other thing as well is that today apparently we're going to be getting some sort of, as Trump likes to say, a sort of major statement on Russia. That could be interesting. Maybe extra sanctions, extra sanctions on fuel and oil and whatnot. So let's just keep an eye on the oil price. You can see here that maybe even anticipating that, you see that since 6 p.m. last night on the futures on the WTI front contract. It's broken above the 200-day moving average. So that's quite sort of bullish here and seems to be breaking a little bit higher. Now, is that sort of trying to front run and anticipate potentially the imposition of potentially heavier new sort of tariffs on Russia's oil exports? Possibly. Therefore, let's see what Trump has to say if he says something. And if that is not confirmed, it could be a sort of a buy the rumor, sell the news kind of situation. And keep in mind here, just from, so technically there is a little bit of a longer term downtrend line, which we are coming across. Let me just extend it out a little bit more. And you can see that we're getting up towards that. So at this point, oil looking sort of quite positive. But again, this could be more of a sort of a news story. And let's see if that's confirmed by Trump. So the other issue as well is that this week we do get some quite interesting data. Obviously, that starts off with the CPI. Now the CPI is coming in. Sorry, just a bit of delay here with the computer links. It's a bit sticky. So you see here the CPI, we're getting that tomorrow. We also get the PPI. What's actually also interesting is that we're starting to get import prices. People are starting to look a little bit more about import prices. We get retail sales, but we get the import price index towards the end of the week. And that's interesting because the market is starting to look at that to understand whether the sort of tariffs are having an effect in the sense that whether exporters are actually charging more for their goods, which would therefore be causing import prices coming into the US to rise. So that's something to look at. And of course, we have initial claims and whatnot. So the issue here is that there is some interesting sort of data, especially about sort of tariff inflation effects. So the point is, will the market sort of think about that? Of course they will, and there could be some reactions. But what I want to just point out here is that we seem to have settled around about 2 cuts. It's either a little bit more or a little bit less. And you can just see here on the tick chart, it sort of goes up and down. But basically, we're going towards just above 54, 53, 54 basis points of cuts to just below 50 basis points of cuts. There's 50, which equals to 2 cuts. So it's just oscillating around that sort of 2 cuts level. And really, I think and you can see that here by December, 2 cuts by the end of the year. So in terms of the end of this month at the July meeting, only 1 basis point of cut priced in, as you can see. So the market is completely discounting that. What's probably going to be more sensitive to the CPI readings will be the September meeting, which, as you can see, has a 63% chance of a cut, which equates to about 16 out of 25 basis points. So, I mean, I don't think that sort of the data tomorrow and then with the PPI will, sort of completely change the Fed's mind, because my opinion, and I think most commentators, is that the Fed is really looking for 2 or 3 months of inflation which is stable or going down, or at least not showing strong effects of inflationary effects from tariffs. And I think even if the numbers tomorrow were to be sort of in line or even a bit softer, which no one is expecting, for sure that would get a reaction and the front end of the curve would go up, the US dollar would weaken, and so on. But the Fed has really told us on multiple occasions, many occasions, that they're looking for 2 or 3 months of sort of data, non-inflationary data, to give the all clear to really start sort of cutting rates, with any kind of regularity. So, will tomorrow move the markets? Yes. Will it signal an absolute beginning of a potential Fed cutting cycle? I think it's still a little bit premature. Okay, but what we can sort of, just stepping back a little bit and grabbing some tea. Well, what sort of caught my attention looking at some charts sort of over the weekend is just the long end of the bond yield. And if we just look at a couple of things here, I just got some charts up. Now, this is normalized going back to essentially the end of last year. This is the 30-year yield for the major sort of bond markets. And you can see that starting at sort of a 0 point, let's call it 100 normalized, which is what I did here on the Bloomberg terminal. You can see here that overall globally, our sort of long yields have gone up. If we start looking at, you can see the US now, there we are, that's sort of risen. We can see the German has risen a lot. We can see that the JGB, so over in Japan, so we see that Germany and Japan, which historically, at least the last 10 years, have had pretty low interest rates. Really, the long end has been ramping up. We also see the UK here in the sort of the light purple, and we also see the Italian one. So we see that all bond yields have gone up, but especially in a global context, Japan and the UK. And you can see that's a sort of a function probably of more sort of spending and basically less efficient supply chains, potentially the tariffs having an effect on, as I say, making supply chains less efficient and causing sort of inflation. Also with the geopolitics, what we've seen in sort of the Middle East, what we've seen sort of with China saber rattling a little bit in the East China Sea, and also obviously sort of with Ukraine and Russia, a lot more spending on sort of defense. And finally, a lot more spending on infrastructure as it's become clear that the US is maybe not going to be the world's policeman, and that a lot of sort of, historical allies, let's say like Australia or Western Europe or sort of Canada or even sort of Mexico, these sort of, sort of friendly countries, so to speak, South Korea, these kind of countries will probably have to spend more on defense and will probably have to spend a little bit more on their own internal infrastructures for electricity, for electrification, whatnot. And all of this is being pushed out into more issuance and sort of steeper yield curves, which has been reflected in higher 10-year yields and higher 30-year yields. And really the question is going to be, and let's just start looking at a couple of charts here, what could be the effect on sort of risk assets? Because for all of the point I'm trying to make here is that all of us are looking at tariffs, obviously, but as you can see here from the sort of the ES chart, we're just looking at the stocks, there hasn't been a huge sort of collapse at this point. So I just wonder if really what could be the sort of the key catalyst is going to be these long-term bonds and real yields getting to a point which is really going to start damaging risk assets. So that's the issue I'm making. Maybe rather than just looking at tariff levels, which by the way is probably going to take several months to actually filter through onto the shelves in terms of costs. Maybe it's really more like real yields and nominal yields we need to be looking at. So if you look at something like the 2-year here, we can see it's in a pretty tight range. I mean, that's the same over in Germany as well. We know, as for the reasons we just discussed, the Fed's not particularly going to be cutting anytime soon, although 2 cuts are still priced in. So the market still believes that. And therefore, I think we're just going to be in a range here of the 2-year. And you'd have to say that if it goes up too much more, let's say around about this 200-day moving average, 404, 405, it's probably going to be capped at the top. So that would probably represent a pretty good buying area, because as I say, it's very, very, very unlikely that the Fed would be hiking. And it more or less seems as though in one shape or another, sometime over the next 3, 4, 5, 6 months, either Powell's Fed will cut or an incoming Fed chair will cut. So the front end of the curve here is pretty much sort of underwater. But what is interesting, if you look at something like the 10-year yield, and then if we look at the 30-year yield, you can see both of those going up. This is the yield chart here on the daily, going up a lot. And you can see that, let's just say hypothetically, anyone who bought at last week's auction, so the 10-year auction and the 30-year auction, anyone who already bought at those levels are already sort of technically sort of offside and losing money as those yields sort of rise higher and the price, of course, goes lower. So what that's telling me is that the front end of the curve is relatively anchored and relatively stable within a sort of a range. And that's obviously going to depend on data and commentary and also sort of CPI and inflation readings. But it's the long end which just wants to go sort of up. And just looking at the 30-year, you have to say, is this going to be heading up towards this sort of recent high, like 513, 514, 515? Certainly looks as though it wants to break above the 5% level. There may be a bit of a pause. And what's going to be interesting, maybe even this week, is that will the dip buyers come in and buy at the 5%? They've done that so far, quite a few times, but really, I think the market looks as though it wants to be pushing a lot higher. Now, if you go back, let's say on a weekly chart, just to put this in a bit of context, so we've got the 30-year yield here, and it does look on the weekly chart. As you see here, just sort of technically, these are all the EMAs. So you've got the 20, the 50, 100, and 200 period EMA. So this is the weekly EMAs. And you see that this is a bullish chart. It's above all the EMAs. And you could argue here also that this is potentially some kind of bull flag here forming on the weeklies and it's breaking out. Now, if that's the case, it looks like maybe it wants to even go a bit higher, maybe up to 5, 16, 17, and then potentially breaking even a lot higher. And so that means the nominal yields here, and we'll look at the real yields in a second. And you see that that's steepening all the curves. So you look at something like the 2s, 5s, and I'll just bring it back here onto a daily. You can see here, this is the 2s, 5s starting to sort of break out again and sort of steepen. So as I say, there's the 2-year more or less sort of capped and just trading in that light range. And the further out the curve we go, we see this upward pressure here. So it looks like we've got the 2s, 5s steepening. We've got, let's say, we'll go on the 2s, 30s. That started to steepen again. You've got the twos, tens also starting to steepen. And then of course, the question is, well, why are we getting all this sort of steepener? And it seems to me that, a lot of it's to do with the real yields. The real yields are going a lot higher. So if we actually just look, just want to take it back to the Bloomberg, I've got the real yields here. I think I put that up. That was my plan this morning. Yeah, so I've got the real yields here on just all across the different tenors in the US, and you can see here on the 5, the real yields. Well, actually, the 5's not as much. I mean, it has gone up a little bit, but if we then look at the 10, you can see it's at over 2%. If you look at the 30, look at that, 2.6%. So the 30 is this sort of apricot color at about 2.66 real yields. Now, the point being here is that if real yields, one thing for nominal yields to be up towards 5% on the 30-year, but if we get real yields at 2.66 and potentially going even a lot higher, that's going to start putting a lot of pressure on the real economy at some point, financing of projects, real estate projects, and of course, eventually that's going to be sort of felt probably in risk assets like sort of equities. So, we're getting this steepening because, as I say, the real yields is just going higher and higher. And again, just what we spoke about earlier, maybe even the FOMC kind of chair. So the question here is that on the 30-year, are we going to get a real yield? If we start going back, you can see the 30-year, we can get a real yield going back, maybe up to sort of 3% or even a little bit above 3.2% if you go back a long way. And that implies that then if that's the case, that implies that the nominal yields on the 30-year will be, well above 5, maybe even up to 5.25, 5.5%. And that is not good for the real economy. And as I just said, for sort of risk assets. And then the other issue as well, of course, is that if Trump does get rid of Powell or Powell resigns, or indeed just the incoming sort of new Fed chair next May, and they start cutting rates relatively aggressively, that will result in more inflation concerns as the bond market, the long bond market, will essentially sort of take the view that the Fed is no longer serious about sort of controlling inflation, and that will cause the long-term nominal yields to go up, and probably also the real yields as well, which of course would be pretty horrible for the US dollar. And just finally, just want to also have a look, actually, just in terms of another chart, the 10s, 30s, which we don't talk about a lot. But if you actually look at the 10s, 30s, which is obviously the long end, more long end of the chart, you can see even that has been pushing up a lot this year. This is back to the daily chart, and you can see it's just steepening, 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 steepening. And one way to look at the 10s, 30s is almost as a sort of a term premium, just sort of risk for holding that longer duration. And the fact that that's steepening is really indicating that sort of under the surface, the market is demanding more sort of a term premium. And I think I've got this here. Let's have a look. Did I bring that up? Yeah, so here's a term premium on the 10-year. You see it's at about 54 basis points. And you can see here on this daily chart that it's just sort of steadily grinding upwards. So keep an eye on the 10s, 30s chart, because that's really sort of indicating the amount of the sort of, how can I say this, the quantity of risk and which the market perceives in that long end of the curve. And I just wonder if at some point, not only in the US, but also we're seeing in Germany, in sort of France and the UK, obviously, and also over in Japan, those long end bonds are really going up and the real yields are really going up. And at a certain point, I sort of think to myself, is that going to cause some kind of a crack in the equity market, especially. We're not there yet. We're not there yet, and equities at high. And we also can see that in terms of the VIX. So if we look at the VIX, which have a look at just now, just bring that up. As I said, it's trading today at about 17.5%. Let me just bring it up, the VIX. And, it probably will have to keep a combination of looking at the nominal yields and the real yields in the 30 years, and let's say something like the VIX, because at the moment, it's relatively calm. And you see there's a lot of moving averages here, all clustered around about the sort of the 20 levels. So at the moment, the VIX, just trading in a little bit of a range, and probably it's the signal to sort of sell equities or sell equities hard. It's probably not until the VIX, really pops above this sort of level around about, let's say 20, 20 and a half, and then sort of maybe closes up above, this sort of 22 level. So really probably what you'd have to see before the equity markets started showing a lot of concern would be the VIX to sort of get above this sort of levels here, as I say, about 20, 20 and a half, and then to actually close above sort of the sort of the danger level, which again is about 22, 22 and a half, something like that. Excuse me. Just finally, just a couple of things on the long bond. I know we're talking about the long bond quite a lot today, but I think it's pretty important. We do have the QRA, so the quarterly refunding announcement in two parts, July 28 and July 30. And of course, the risk there, excuse me. My throat gets dry talking all the time. The risk there, of course, is that Besant and the US Treasury might decide to actually reduce the number of long bonds being sold because Trump has said that he just wants to sort of issue bills rather than bonds. And for sure, in the short term, that could cause a boost to the long bond, which would push down the yields. So that's definitely, I do apologize, something which could, actually, I think make a more interesting kind of level to short if we did get a bit of a rally. And just finally, just keep an eye on something like the TLT, which of course reflects, that sort of 20 to 30 year sort of duration. And if you just actually go back a little bit, let's go back on, let's say on a weekly or something, you see that we're getting down towards levels where historically we haven't been for quite a long time. And I just wonder if, if we get the nominal yields and the real yields pushing higher, could that just get down here, maybe sort of stop out everyone, just have a final little puke downwards? That would be quite interesting. And maybe at that point, then that's really, that could be, let's say, the signal to start to think about sort of maybe buying equities. Maybe that would be if the TLT got all the way down here, let's say below, that sort of 80 level, stopped everyone out down there. Everyone panics, bonds sort of stocks are collapsing. Maybe, sort of over the medium term, that could be an interesting sort of buy point for TLT. We're not there yet, but if you look at this chart, this definitely, just in terms of momentum and the moving averages on the weekly, this is definitely looks as though it's sort of pushing ever lower at this point and no real sign of stabilization. And maybe, as I say, we're going to have to get back to these sort of historical lows. Just thinking how far this goes back, I'm not sure, to be absolutely honest. Yeah, if you go back on a monthly, you see how just crucial this sort of period is. This is my point. If you go all the way back to the early 2000s, it could be that that's going to be the ultimate range for the TLT. We shall see what happens over the next sort of few weeks and months. Okay, just moving on to other things. I was going to talk about Germany, but I don't want to talk about that too much. But essentially, it is the same kind of situation over in Germany. They have infrastructure spending. They have it's very problematic to fund their sort of social welfare programs with their demographics. They also have military spending. So the point is here, there's more and more issuance coming to the long end, as we've discussed. You can see here something like the 2s, 10s. It's sort of, continues to ramp higher on the steepener. And you look at the 2s, 30s, you can see that's also steepening and sort of ramping higher. So also over in sort of Western Europe, or specifically Germany, that steepening is occurring. Okay, so just getting back to some other markets quickly. Interesting is that the dollar, listen, as I said, for the reasons we've spoken about, the dollar weakness continuing is definitely a possibility. You see here the trends are all sort of pointing downwards. Is this some kind of sort of reversal, or is this just a sort of I don't want to say a dead cat bounce, but just like a bit of, just a little bit of a bounce? It does look that way. But let's be honest, this has been going on now for about 8, 9, 10 days. And this is not a strong sort of bounce back. Like we don't have any of these big, strong green candles. It's been sort of grinding a bit higher. It's finally got, above this sort of downtrend line. It's now just sort of creeping above the 20-day moving average. So for sure, is it possible that this could move up a little bit? I mean, maybe something like, 98, 80 up to the 50-day moving average, where there's a little bit of horizontal, sort of quite a lot of volume and horizontal resistance. That's an interesting one. If we throw that on a weekly, you can get a sense here of, what something like that might look like, you're sort of getting up to, sort of levels up around here. So can the dollar go up a percent or two more? Yes, I think that's possible. But at that point, it's possible, it's quite possibly a much more interesting and attractive area to reset the short. So that's something I'll be looking at in theory around about, 98.8, 99, this sort of, 50-day moving average where there's quite a lot of historical, sort of level resistance. And the point is that the dollar has been very, very shorted from a positioning point of view. It's very, very oversold, as we all know. So this kind of rally is nothing to be unexpected. And the question really here is this actually some kind of sort of bear flag? It's just like a flagging formation and ready to go for the next move downwards. And if we put some Fibonacci extended sort of measured moves, we can do some, shorter term ones, measuring a move down there. We can do some, sort of longer term ones. whichever way you sort of want to go here. Pick your poison, whichever sort of time frame you want to use. But it does seem as though, sort of at least a retest of the bottoms down around about 96.5 or even further down are definitely potentially on the table for the dollar index. Just want to finally just have a quick look at equities, guys. As I say, VIX is at low levels. If we look at the cash index, the SPX, give us a sense. So you see all the moving averages, the 20-day crossed over the 50 a long time ago, all the moving averages pointing upwards. This is still in a strong sort of upward momentum, one could argue, definitely. And so there's nothing sort of negative about this. Now, tariffs, will it sort of dip a little bit here and there? Sure. But remember, the longer we go on, the more time the market will have had to have sort of incorporated all of this. And I'd say that just a couple of key levels on the different sort of time frames here. I would say that, let's say on the daily, you can look at something like, 61440, something like around about here, which coincides approximately with the 20-day moving average. A little pullback back to there would be absolutely reasonable and expected and is not at all sort of bearish. If we just extend it out and just try and get a bit of perspective here on the weekly, maybe you're looking at, something like 61, 61. 10, something like that. Let's have a look here. I've got these levels, something more like around about this, like 61, 15, something around about there would be sort of a level to be looking at. And then if you go all the way back monthlies, just to get some kind of, sort of a longer term perspective, again, you see this very strong uptrend. Where could sort of some kind of resistance be? And you're looking maybe around a bit lower, maybe about 60, 50 or something like that. So absolutely possible for a short-term sort of pullback, 100 or 200 points. But again, just to emphasize the fact that the market knows about tariffs. We've got the European tariffs and the Mexican tariffs and the Canadian tariffs. Still no deal, no mention of a deal with China, and the equity market seems happy here. So I think really what we need to be looking at is probably what's happening with inflation, the Fed, and also let's keep an eye, as I've spent a lot of time talking about, on the nominal yields and specifically the real yields at the long end of the curve. Because I think if we start getting real yields above, let's say 3% and nominal yields above, let's say 5.25%, 5.5% on the 30-year, that will have a significant effect on the real economy. And that maybe is the moment where potentially the equity market really does start to crack. But again, we're not there today. Today, we need to worry about sort of Fed speak and tariffs and comments on Russia. And, is Powell going to resign? And of course, we have the data coming up over the next 3 or 4 days. Okay, I'll leave it there, guys. Sorry, I had a long one. I'd like to have a nice review on Monday morning. Let's keep the conversation going. Thank you very much.